Talk Business is brought to you by the Washington Center for Women in Business, and I'll talk a little bit more about the WCWB in just a moment here. But first, a little bit of housekeeping. This webinar is being recorded, so if you need to listen to something again or want to send it to a colleague or a friend, you're welcome to do that. The link for the recording will be emailed out later today. Please mute yourself in between asking questions or participating. There's two ways you can do it. There is a green microphone symbol on your control panel kind of on the side here. And there's also one if you find your name under the attendee list. Either one, if you just click it, you can mute it. You might find I have muted some of you, that there was a lot of noise when we were logging on. If I've muted you, I will try to unmute you if you send me a little note that you want to speak, or that doesn't mean that you're not allowed to speak. I'm just trying to cut down the noise here. And if there are any background noises, I'll mute anybody as appropriate. Audio, if you're having trouble hearing for any reason, I highly recommend using your phone to call in. There in the audio pane, there is an option to either use your computer speakers or the phone call. If you're having no issues with the computer speakers, then no need to change, but if you're having issues, that's a good one. And then if you have any questions, there's two ways to ask. We had a question today that said, do I need a mic to participate? You don't need a microphone unless you'd want to use the mic to ask questions or participate, but you can also just chat in the chat box here, and Oliver and myself will be able to see those. If you would like me to unmute you, or if you'd like to ask a question, there is also this raising hand button that should be on this control pane right here to signal that you have a question or you have a comment. Is there any questions about any of that? Great. So the Washington Center for Women in Business is funded in part by the U.S. Small Business Administration. Our whole mission is to help women who want to either start a business, grow a business, or strengthen their business. You can see on the screen just some of the things that we help businesses with, because everybody's a little different. So we might work with you or work with somebody on different things depending on what your strengths are, weaknesses, gaps, things that you're trying to move forward on, goals, that sort of thing. And I know we have a couple men in the audience. We do, even though we're the Washington Center for Women in Business, we're happy to help any man that needs the help. Probably 20% of our clients are male-owned businesses. We help the businesses with webinars like this, providing trainings. It can be online or in person, but then a lot of one-on-one coaching with our business coach, Christine Buckley. So that's when you'd sit down with her, you'd figure out your goal, and then we would help get you there. We are located in Lacey, Washington, but we cover the whole state of Washington. So if you're outside of the Thurston County area or it's hard to get into the office, we are happy to help with phone, email, Skype. There's ways that we can connect with you besides being face-to-face. It is free to meet with us for the first time. Every session after that is $25 an hour, but there are scholarships available if you need it. And there's all of our contact information there. I am Tracy Hansen. Christine Buckley is our business coach, or you can also contact Ryan if you want to schedule time with Christine. Either of those options work. Now with that, I will change the presenter over to you, Oliver.
Very good. Thank you very much. I was having trouble with my mute button there.
There you go.
So thank you all for coming today. My name's Oliver Scott, and I'm a loan officer here in the Pacific Northwest for the National Development Corporation's Grow America Fund. What I'm going to do is tell you a little bit about our organization and what we do, and then talk about what lenders look for when you submit a loan application. And finally, we'll go over kind of the landscape of different kinds of lenders that are out there, what they're looking for, and basically give you a better idea when you're putting together your loan application, where you fit within it all. The National Development Council was founded in 1969. It's based in New York, but we work nationwide. Our mission is to increase the flow of capital for investment in low-income communities. And we do this in a number of different ways. The ideas fall into three categories, though: homes, jobs, and community. We do, what we're most known for, actually, is for training. We conduct a lot of training for economic development professionals. Most economic development folks who work in cities went through our training. We're very well known for that. We also do affordable housing projects. We do new markets tax credit projects. We do big public-private partnership projects. And where I come in, the Grow America Fund, is we do small business funds. What separates the Grow America Fund from other lending organizations out there, mission-based lenders out there, is that we partner with local communities. So we connect with the city, and we have contracts with the city of Seattle, the city of Tacoma, the city of Olympia, as well as King County, Pierce County, and we manage their revolving loan funds. So we do the outreach, we do the underwriting, and we focus on helping businesses create and retain jobs. We work in 40 communities all over the U.S., north, south, east, and west. And with that, I'm going to go into the 5 C's of credit. It's funny because I have a friend who is now a finance professor at Columbia, and he once told me when we were discussing it, he said, everybody says the 5 C's of credit, but I think they're more like 9. But we stick with 5 because it's easier, and I'll tell you how the other C's kind of get grouped into here. I put these in order of importance, and I'm going to go into each in detail right after this slide. But the first and most important is cash flow. Are you able to repay the loan? The second is collateral. Do you have enough collateral to secure the loan? If you're unable to repay it, how can we recoup some of the money that we've lost? Character. Do you have a responsible credit history? Capacity. Can you take on additional debt, and how was that debt used? And conditions. What are the market conditions for the business industry? And added into there, some folks put it into character, some people put it into conditions, is your individual experience and what you know about the market and the industry that you're working in. So more detail about each of those. Cash flow. We all know what cash flow is king. It's what keeps your business alive. So the first thing that a lender looks at is to see if the business cash flow is positive. Are you making money? Are you profitable? And it's very important to keep this in mind. I think a lot of people forget when applying for a loan that a loan is an extra expense. You're getting the money up front, but going on month to month, you're going to have to repay. And so you might have enough money. You may think that you can just get the money and worry about the payments later, but that's not how a lender is going to look at it. Is the business highly seasonal? If you are a food truck in Seattle, what are you going to do during those rainy times when not so many people are going to be out buying food from you? This is especially important if you're a startup, but if there's any outside income to help support your household expenses. If If you are starting up, it's likely that the first year, or maybe even two, you're not going to be making enough money to support your household expenses. So how do those get covered? Outside income, savings, wherever it may be. But we look at that and we take that into consideration. And whether the revenue is sufficient to cover the cost of a loan, that is called the debt service coverage. It's a pretty simple ratio. It takes the amount of cash that you have after all of your expenses and divides it by the loan payments. Collateral. How will the loan be secured? There are a number of ways. The way that I've listed them goes from easiest and best from a lender's perspective down to the worst, if you will. Cash securities are the best. CDs, MMAs, non-retirement investments. What that means, frankly, is you want a $100,000 loan. You have $100,000. You put it into one of these vehicles, and we hold on to it until we get repaid. The benefit of that, of course, because a lot of people ask, why would you do that if you already have the money? Why would you borrow it? A big part of it is that you're putting our money at risk, right? So let's say you try a project and you get down, you've paid off $50,000 of the loan, but your business goes belly up. The bank will take that $50,000. You'll still have $50,000 left over. Whereas if you invested that $100,000 yourself and the business goes belly up, you've got nothing. You lost it all. So there are good reasons why you'd want to do that. The second is real estate, commercial or residential. Commercial real estate is generally less valuable than residential. And we'll get into that in a second. Your business assets, equipment, your accounts receivable, inventory, all of those get calculated into the collateral discussion. Vehicles, this is really for microloans. My background is in doing microloans, and we would often use vehicles because it's something that everybody has for the most part, and for small loans, it makes us feel comfortable that we have some asset, but it's not too burdensome on the borrower. So what we look at here is we look at loan to value. So we want the loan as a lender. We want the loan to be small in relation to the value. An important aspect of collateral that I don't think anybody really understands, and that is discounting. When you might have a piece of real estate that is appraised for $500,000, let's say. If we need to collect on that real estate, if your loan goes belly up and we need to take that real estate and foreclose on it, we're not going to get $500,000 for it. We're not going to get market rate. And so when we are doing our calculation of what your collateral is going to be worth, we're using a discounted rate to figure out what we would actually get for it. So we get this all the time. Folks that come and say, I paid $40,000 for this piece of equipment that I have installed in my business. It should be worth $40,000. No, actually it's not, because we'll be selling it used on the secondary market, and we will be lucky to get $2,000 or $3,000 for it. And so it's important to keep that in mind when determining how much collateral you have. That there's that whatever it is, it's going to be discounted. The only collateral that does not get discounted is cash. Character. Will the borrower repay the debt? Is the borrower honest? What's really interesting is folks that try to think that they can get one over on us by not telling us something and not disclosing something. We get down and dirty into the weeds of your application, and if you have not disclosed something to us and we find it out later, we're not likely to trust you. And if we don't trust you, then why would we trust you with thousands of dollars of our money? I think that, honest, we're trying to build a relationship here of trust. And so be honest. And when you're not honest, it makes it so much more difficult to get the deal done. Another way of showing character is through equity injection. I think that this is unique in the field, but I consider the equity injection as a point of character, because especially if you're starting up, if you can get friends, family, investors interested in your project and putting money towards it, that you can put towards starting up your project, then we know we have a better feel that your idea is a good one and that people believe in you and that you can make this happen. If you're not able to get that, if nobody wants to invest in you and nobody that you know believes in your idea, it makes it that much more difficult for us to believe in it. And so you having skin in the game is very important. We want to see that, if you've got a $100,000 project, we're not going to finance $100,000. We're not going to put all of our money at risk while you're just risk-free. So you need to put in, for a startup, usually we want to see 20, 25%. And for really risky types of businesses like restaurants, for example, many members will want to see 40 to 45%. But we'll get into that, those equity injection numbers a bit later when we start discussing what the landscape is. Something to keep in mind that I like about what I do, as opposed to working for a bank, say, is the difference between a credit score versus credit history. A bank looks at your credit score and makes a determination. Of course, they look at other things, but if everything else is good and your credit score is below their minimum, then they say no, and that's it. They don't ask why, and that's largely due to regulations. They're holding our deposits, right? And so we don't want them to invest in bad deals. Look at 2008. So what we do, we can be a little bit more flexible. So if you say, I lost my job and due to illness, and it caused me to miss some payment, but when all of that got fixed, I got back on track. And I can look at your credit report and see that. Is it something that, was just a one-time thing? And I can see that in the report, or is it that you just habitually don't pay your bills? If it's the latter, then that's much more difficult, obviously. I like to include here things about most people probably know, but some aspects that you might not. What is good credit versus bad credit? What things will ding your credit and hurt your credit more? And what help it? Having long established history with your accounts, that's very good. Having a good payment history. High credit limits with low balances. So that means that you have credit cards, for example, with really high limits, but you're not using them that much. We call that high revolving availability. experience with a mix of revolving and installment debt. The difference between revolving and installment is kind of like what our business loan is. We give you money, you spend it, and then our relationship is done. Think of a student loan, an auto loan, anything like that, right? They're giving you the money up, you're paying it off, and at the end of it, you're done. Revolving is more like a credit card, where you can use it, pay it off, and then go use it again. Mm-hmm. So we like to see that you have experience doing both of those. And of course, experience handling similar levels of installment debt. If the largest loan you've ever had in your life was a $2,000 car loan, then coming and asking for $1 million is going to be pretty difficult. Bad credit, most of this goes without saying. Bankruptcies obviously hurt. Past due, things in collections. Low revolving availability. So if you recall, that is when your credit cards are maxed out. Multiple home refinances with increasing balances. That shows that you're taking in a lot of cash, and what are you using it for? Charge-offs, settled for less than full balance. You hear those, well, first of all, a charge-off is when a creditor just gives up trying to collect from you. They say, well, we've tried and tried and tried, and this person's not going to pay us, and so we're going to charge it off, and that looks very bad. You hear all the radio ads saying, you have a right to not pay your bill, your complete bill. You don't have to pay it in full. That's true. But it'll be settled for less than the full balance, and that will show up on your credit report. And that is not good either. Judgments, that means somebody has sued you and you lost, and so you have to pay. And tax liens. If you owe taxes and the government has lien on you, it's very difficult to get your money. And the last two kind of make, if you think about it, kind of makes sense, because in those last two, you're messing with the government. And the government can freeze your accounts, they can garnish your wages, they can do anything they want to get repaid. And so if you're in that situation and I lend you money, my money is very much at risk. Capacity. Can the borrower take on additional debt? I think that especially when you're talking about startups and businesses in the early stages, I think that this is very tied to cash flow. Can you afford it? And if there is existing debt, how was it used? Did you use it to improve your company, or did you use it to buy all your employees Cadillac Escalades? Again, we look at how much revolving versus installment debt that you have, and we like to see that there's positive net worth. If you have a business that has a lot of assets, but those assets are offset by a whole lot of liabilities, by a whole lot of debts, then your net worth is going to be lower. And if you owe more than you own, then you're going to have negative net worth. That usually occurs because of one of two things. One, either you're taking out money from the business and using it for personal uses, or two, your business is suffering losses. Either way, it's difficult for a lender to get around that. And the ratio that we use here is debt to equity. So you look at your net worth, and that's the denominator, and then the numerator is the debt. How much total debt that you owe. And it's difficult to give you a number for these because it really depends on the industry. Some industries need debt to keep moving, and other industries don't. Think like a manufacturer or a contractor. They will need more debt because they will need to purchase large pieces of equipment that they probably don't have the cash for, or in the case of contractors, they will need to perform work before they get paid for it. And so those industries, you can expect to see more debt than, say, a cafe or a restaurant, which shouldn't have a lot of debt because it's just a cash-based business. Conditions. Is your business existing or a startup? My organization, for example, we don't work with startups. And so we work with only existing businesses, and because of that, we can do 100% financing, right? We can say, whatever your project is, we'll finance 100% of it because we already know that you're in business and you're doing well, and we don't require that equity injection. If you're a startup, anybody that does do startups, and I used to, half of my old portfolio used to be startups, so I'm very experienced in this. That's a whole different set of worms, right? And so, does the business model or concept work? I used to say, are you trying to sell ice cream to Eskimos? But I did a loan to an ice cream manufacturer in Alaska, and discovered through my research that Alaska is the #1 per capita consumer of ice cream in the United States. So who knew? My friend from Alaska said that it's because they don't wait for it to be warm to enjoy it. But you get the idea. Is this a model that's going to work? Is it a concept that's going to work? And do you know the industry? How confident are you that this is going to work? How much research have you done? Do you know who your customer is going to be? Can the borrower grow this business? And that's very strong because I think that there's a lot of talk about everybody can be an entrepreneur, but it's tough work. I'm glad I'm not one. I have the easy job. I get to lend them money. I don't know if I could work 14-hour days every day, 7 days a week. So, are you the type of person that is the go-getter that will go and sell your product, sell your service, and make this business successful? Are the projections realistic? What I like to focus on here is tangibility. I think it's very important for especially startups. Get signed contracts, get promises to buy, demonstrate some sort of success. If you're wanting to open a restaurant, show that you've been selling at farmers markets or you've been selling at fairs, that you've been catering, and that you have a following of people that when you open the doors, they're going to be banging down the door to get into your restaurant. Similarly, if you're going to be offering a service, you have people that say, I'm willing to contract you to do this X amount of work for Y amount of dollars. So that then you have a really good idea, month one, how much am I going to make? And then you can build your projections out from there. It's very important for them to be realistic. We hear, every entrepreneur thinks they're going to make $1 million in the first year. And I've only seen it twice, and one of those went out of business because he had grown too fast. So make sure that your projections are realistic. And potential obstacles mitigated. That comes into play in your business plan. You're not going to be able to mitigate all obstacles, but try to get as many as you can and say, if this happens, then I've got path A, path B, to avoid problems as a result. So those are the 5 C's of credit. I think that I've been talking a lot, so I'm going to pause a second and see if there are any questions about the 5 C's of credit before I move on. Okay, hearing none.
Yeah, I don't Coming through on the chat.
Oh, are they? Okay.
They are not, no.
Nope. Okay. So we'll go into the credit products that are out there. The most common is term loan. That, to use the vernacular that we have introduced to you all today, that is installment debt. Again, you have a project, we finance it, you pay us off, and we shake hands and say goodbye. A line of credit, that is similar to a credit card. Usually lines of credit are cheaper, but it's the exact same concept. You can spend the money, pay it off, and then you can use it again. They usually go for 1 or 2 years, and as long as the bank is happy with how you've been handling it, they will extend it. Seller carry financing. This is when, say, you're purchasing a piece of real estate for your business, or you are purchasing a business from somebody. This is where the seller finances it. So the seller agrees that you'll put 25% down and then make payments to them the rest until it's paid off. And finally, there's factoring merchant cash advances. Factoring is if you have a whole lot of accounts receivable, you can take those to a factor. And you say, look, I've got $100,000 of people that are that owe me money. And the factor will say, okay, well, I'll pay you $80,000 for those accounts now. And so you get $80,000, and then the factor gets that $100,000 when they get paid. It's usually how it works. So you're usually going to get about 80% of your money on those. Merchant cash advances work very similarly. And so I've put these in kind of order of pricing and difficulty of getting. So term loans and lines of credit are more difficult, but are usually cheaper. Seller carry financing. That really depends how well you know the owner and whether they're willing to cut you a deal or something. But usually a seller is not going to give you terms as favorable as a bank or other lending institution would. And factoring is the easiest to get, but it's also the most expensive. The lending landscape. Let's talk about who's out there lending money. A lot of people think that it ends here, traditional banks. And what I'm here to tell you is that that's not true. And I think as an industry, we're having a tough time getting the word out there that this is the case. But having been doing this for about 11 years now, it's definitely better than when I started. In addition to traditional banks, there are also what are called CDFIs, Community Development Financial Institutions, or CDCs, Community Development Corporations. Now, what these folks do is, and I've tied them to the SBA products just because I think that it's a good, that they provide a good framework for what they do, for what these types of lenders do, although they're not necessarily SBA loans. The SBA 504, this is what CDCs do. This is commercial real estate. SBA 7As, that's what I do. You can go up to $5 million, and you can basically use it for anything you want as long as you're not putting the money in your pocket. The SBA Community Advantage Program goes up to $250,000, and microlenders up to $50,000. Again, I put these in order of difficulty to get price of the money. So an SBA 504 is probably the most difficult to get, but it's also very cheap money. And then going down, microlenders, relatively easier to get a microloan but it's also going to cost you more. And finally, there are online lenders, and I'm going to talk about each of these in a little bit of detail. The message is always try your bank first. If you have a relationship with a bank holding your accounts, they want to try to keep that relationship. And they know you, right? So they know what you've been putting in the bank. They know what you've been taking out. And they have a pretty good idea of who you are and what you're doing in your business. So always just start with them. But know that banks are not the end-all be-all. But it's going to be the cheapest money, usually about 5 to 6%. It's also the slowest. Usually takes 2 to 3 months to get a bank deal because they're really trying to mitigate their risk as much as possible. And it takes time to really mull over a deal and say, is this something that we can really get behind? Well, the mantra to remember when looking for money from a bank is that they want safe and secure investments. A lot of that is because of regulations, and for good reason, because we saw in 2008 when they weren't lending this safe and secure loans, what it did to our economy. They're holding our deposits, so we don't want them to lose those. So when they are looking at cash flow, they want a debt service coverage ratio of 1.25 to 1.35. What does that mean? That means that if you are asking for, or if your loan, rather, is going to cost you $100,000 a year, they want to see that you're making $125,000, $135,000 of cash, right? So that you have a 25 to 35% buffer for repaying the loan. They want to see collateral, usually at least 100%. They want to see FICO scores, your credit scores of 750 or higher. They're going to look at your debt equity in relation to the industry that you're in. So they look at, we have books that show us what the ratios are for every industry that you can imagine, almost. And so we can compare, okay, you have a 2.0 debt to equity, and folks in your industry usually have 3 or 4, so we know that you're good. And conditions. Usually banks don't lend to startups. They're looking for existing businesses in stable industries and markets. They don't want to be surprised by anything. And what you'll see often is that there are banks that focus on certain industries because they feel comfortable with those. I hear, although I can't vouch for the truth of this, but I hear that Columbia Bank, for example, really loves retirement homes. They've done a lot of those deals. They know how to look at them and determine whether they're good or not. And so they feel safe making those investments. Community development corporations. These organizations do the 504. Of all of the SBA products, I think that this is the most difficult to get. It's a partnership between the CDC and the bank. The bank puts up 50% of the cost. The CDC puts up 40%, and you, the borrower, put in 10. So it's a very good deal if you can get it. You're talking about 10% down on a piece of commercial real estate. You get a 25-year term. You get a low interest rate. It was 4.63% as of January. But the issue is that they're almost as strict as a bank, right? Because you are the bank is already saying, we're willing to lend to you, but we may not be willing to lend so much to you, right? So you're already meeting their requirements, at least to a certain extent. And so it's the most difficult to get. In the Puget Sound, I know of Evergreen Business Capital, who is a CDC and does these 504 loans. CDFIs usually do, as far as the community advantage type loans. So think of these as up to $250,000. These are deals that, for whatever reason, are not able to get money from the bank or a 504, or they're using money for different purposes. Remember, the 504 is it's a long-term loan. It's investing in real estate. If you're wanting to buy a little piece of equipment or refinance some debt or just working capital, the 504 is not for you. Community Advantage, up to $250,000, they can be a little bit more flexible about credit, which means that it's also going to be more risky and so more expensive. It's kind of slow. Usually take about 6 to 8 weeks to get through one of these loans. But again, what I like to show in this presentation is the correlation between price and speed. So as I said, they're less strict. They'll usually want to see a debt service coverage ratio of 1.15, so only 15%. Less than 100% collateral is okay, especially if they're using the SBA guarantee. Lower FICO is okay, again, keeping in mind the credit score versus the credit history. Debt capacity is really up to the lender. I know that for example, when I was doing it, when I was working with a lot of startups, we almost never looked at this. Conditions, startups can get financed with Community Advantage. If you're in tougher industries, pizza shops, for example, Community Advantage is really good for a really good match for those kinds of deals. In the Puget Sound, I know of Evergreen Business Capital, Business Impact Northwest, and Craft 3 offer this product and or something similar. Then there are the microloans. These go up to $50,000. They're kind of pricey. They're usually between 9 and 16%. But they're also faster. You can get the money usually in 3 to 4 weeks, depending on on the organization. They're less strict. We usually looked at, just straight cash flow, 1-to-1. If you're making enough to prepay the loan, we're good to go. Again, we're not so hooked up on collateral. Lower FICOs are okay. Capacity is up to the lender. And again, startups in tougher industries, this is a good, and I really want to suggest, from a paperwork standpoint, the microloan is very, very low doc. And so that's one reason why it's a lot quicker. And so if you're looking for, a $20,000, $25,000 loan, it's really a much better match for you, even though it's a little bit more pricey. And the reason is because if you were to go for a Community Advantage or a 7A loan for $25,000, you'll probably want to wring somebody's neck at the end of it. The microlenders out here that I know of are Mercy Corps Northwest, Business Impact Northwest, the Northwest Access Fund for folks that are disabled. And I just gave this presentation, was told that Craft 3 also does microloans. So I'll need to add them on here, but Craft 3 does those as well. Online lenders are scary. Hopefully you've heard that. But I do want to say that there are exceptions. But they're usually up to 50,000. Frankly, it's usurious. I've seen as high as 400%. And these folks, they get your bank account and they'll take out, some of them will take out money every day. And you can't stop them because they have your bank account information. But they're the fastest. If you get into a situation where you need the money in 3 or 4 days, that's going to cost you money. It's the least strict. They basically ask, do you have a pulse and money that we can take? The worst ones that I've seen are On Deck and Cabbage. I would definitely stay away from those. The exceptions that I've noticed are Lending Club. I've seen Lending Club loans as low as 8%, which, you know, again, is pretty reasonable given the market that they're working in. And small biz loans is a rather new concept because they do SBA loans, and they claim that they can get them done in a week. I think that sounds very miraculous if it's true, but it's just that I include them on here because it is an online lender, and as because they're working with the SBA, the costs that they can charge you are regulated and capped. So you know that it's not going to be one of these 400% deals. What does the application process look like? This process is pretty much the same throughout all lenders. The first thing they're going to do is a pre-screening. They're going to talk to you. Going to and that conversation can be it usually takes about half an hour. That is an opportunity for you to tell them what it is that you do, how you make money, what your project is for, what you need the money for, what other money you have to put towards the project. All of that stuff gets discussed. What I usually do, even to pre-screen, since I'm working with existing businesses, is I have them send me their financials up front so that I can just do a quick crunch of the numbers and say, okay, this is something that we can do. Because the application for 7A loans is quite a hefty task, and I don't want to waste their time, and I don't want to waste my time. So I look at the financials and see if this is a doable deal before sending out the application. And most lenders will do that. So we submit once you've submitted the application and the documentation that's required to go with it, then it goes into underwriting. The underwriter crunches all the numbers, makes sure that all those ratios are where they want them to be. They usually conduct a site visit. Online lenders obviously probably don't, but most traditional lenders and CDFIs at microlenders, et cetera, will come by and they'll want to see your place of work and learn a little bit. This is where, since they've done the underwriting, they'll have some more specific questions for you, so you can get those nailed down. Once the underwriter is happy with it, they submit it to the loan committee, or they present it to the loan committee, and the loan committee makes a decision. If it's approved, it goes through compliance. So all of that documentation that you were supposed to provide with the application, these folks go through it and make sure that all of that's there. And then closing, and that's when you get your money. And so that's pretty much the process. And that is my presentation for today. Are there any questions?
Tamara says this is just what she needed, what she wanted and what she needed. It was simple to understand.
Thank you.
I echo her thanks. That was great information.
Thank you.
Does anybody else have a question for Oliver while we have him on the line?
Yes, I do. It's Vivian.
Hi.
Thank you for presenting, Oliver. Yes, very informative.
Yeah.
I have a question regarding the microloan. I was looked into getting a finance on my property. It has no home, but my traditional bank said because there's no home, we're not able to get a small microloan off of it. But these micro loan companies that you have listed, do they give loans off of a property, or do you know of?
Well, it all of these products that I discussed are for business loans.
Okay.
And so there would have to be some sort of a business tied to, if you were, say, for example, I assume that it's a piece of land that you have.
Yes, it's a piece of land. So the land that we have is eventually will be my residence, but it's also commercial for our business. So we wanted
Sure.
to get a small loan so that we can get equipment and get this startup. So I'm in the startup phase.
Okay. So yeah, I mean, if you were, these loans would be appropriate if you were, say, building a microloan. You're probably not going to be able to finance the construction of the location. What they're going to look at, say, if you want a 504 loan or you want another SBA loan to do this, they want to make sure that the business is going to be occupying 51% of the space. Okay, so that's important to know for SBA purposes, and I would say for most business lending purposes.
Okay.
Usually, shop around, of course, but usually when you're doing residential stuff, residential is cheaper than business. Yeah. So if you're doing something residential, you can usually find cheaper products out there for you.
Okay, so I could go ahead and shop around. All right, I just thought, oh, well, maybe we could do this because we want to go mobile. Our business is going to be mobile, but the headquarters will be on the property that we have.
Right. So you probably, in that case, you likely will not qualify for SBA financing. But that doesn't mean that there are other, I know that Business Impact Northwest, Crap 3, and maybe Mercy Corps, I'm not sure. They also have pots of money that are not SBA that they can be more flexible with. So as long as you couch it as a business use, then it's something that they can do.
Okay, I'll give them a call and check it out. Well, thank you so much.
No problem. Thank you. And I saw a very good question from Lisa Daniel. How do you feel about Kickstarter or other funding possibilities? I love them. I think that it's great. And for, especially when I worked with startups, as I mentioned about the equity injection, it was another way for us to feel comfortable that this was a deal, this is an idea and a business and that people believed in, and it would be and therefore more likely to be successful. And so I guess I would add to the saying is friends, families, and fools to invest in your idea. I would definitely add this crowdfunding to that list. I mean, really, and I didn't include them because they're not a local actor, but there's an organization called Kiva, that's spelled Kiva. They offer a product that just can't be beat if you're looking for a microloan, $10,000 or under. It's 0% interest and no fees. You're not going to find a better deal than that. So if you go to Kiva, I believe that it's a .org. I might be wrong. It's definitely a nonprofit, obviously, because you're not going to make money lending out and not charging anything. But if you're looking for $5,000, it's a really good deal. You're not going to find a better one.
And Oliver, you're going to be sending me the presentation that I can send out to everybody, correct?
Yep. I will send it right now.
There's a couple Oh, sorry?
I will send it as soon as we're done.
Yeah.
I didn't realize there were more questions. So I was going to say I'll send it to you, but definitely can send a copy of the presentation.
Great.
And then
so when I send out the recording to everybody. Oh, I'm sorry?
Yeah, sorry. There was another question here. I was going to try to answer it. But
okay, go for it.
Don't let me interrupt. Donna asks, my company has been in business for 5 years. Is there a limit as to how old the company can be for an SBA loan? Oh, no. And in fact, as I mentioned, we especially my organization, we want to look at businesses like yours that have been in business for a while. You're already successful, and you're looking to expand, maybe open up another location. Maybe you're taking on more work and need working capital to fulfill it. Those kinds of things. So definitely not. The limit would be in the other direction. That lenders, and these are not SBA regulations, but most lenders will say if you haven't been in business for 2 years at least, then it's going to be difficult for them to lend to you, just because you don't have that track record yet. Oh, and Lisa also asked about angel funding. Angel funding is great. The problem with it is it depends on the organization. There are good ones, there are bad ones, and it depends on how much of the company you're willing to give up. Because as opposed to a loan, where once you've paid it off, we're out of your hair. With angel funding, you're usually giving up a percentage of your business, and so they will always be there. Now, the benefit is that they can be, what's the word there's a word that I always use. They can be more patient. And an investor can wait a year to maybe, depending on what they're interested in, maybe even longer before they start getting paid off. Whereas a loan, you don't have that option. When I make you a loan, you're going to have to start making payments next month. And maybe we can work something out for 6 months, interest free or something like that. But the idea is that once we've made you the loan, you're going to have to start paying it back very soon. Whereas investors may not be so require the money so fast. But again, you're giving up part of your company too, and you're giving up a piece of your profits to them. If they are doing so because they're coming in kind of like not just angel investors, but venture capital, maybe these are folks that have a lot of experience in the industry that you're working in, and they're going to be able to give you a whole lot of advice on how to be successful. Then maybe giving them some of their company is beneficial, and will help your company grow. So those are all things to consider if you're looking in that direction. It might be, like I said, really experienced folks, that have started companies and been successful with them. It's really good to have their advice. They could probably help you out a lot. But it's just a question of how much of your company you're willing to give up for that advice.
Well, great. That brings us to 1 o'clock, so perfect timing. If you have any other questions, please feel free to send them in, and I'll make sure they get to Oliver. And yes, look for your email later today. I'll have the slides and the recording out, as well as the links to some of these loans that Oliver mentioned today. I'll send you to that. And with that, that's it, unless you have anything else to add.
Stacey, I just had one more thing. I was just going to say that, I've got my contact information here on the, if you have any other questions, you can contact me directly as well. Okay?
Great. Well, thank you so much, Oliver, and thank you for everybody, and have a great rest of your Wednesday.